Welcome to the world where finance meets the future. Today we're diving into the fascinating world of dividend and growth ETFs, specifically SCHD and SCHG. Picture this. You're at a party, and instead of people, the guests are different types of investments. You've got stocks in one corner, bonds in another, and then, making a grand entrance, you have exchange-traded funds, or ETFs. Unlike their party counterparts who like to go solo, ETFs are the life of the party, bringing together a diverse mix of investments under one roof. In essence, ETFs are investment funds traded on stock exchanges. They encompass multiple types of investments, including stocks, commodities, or bonds, and they typically aim to track the performance of specific indexes. ETFs are like a buffet of investments where you get a bit of everything, providing diversification and reducing the risk associated with investing in individual stocks or bonds. Now let's meet our two guests of honor at this party, the Dividend ETF, SCHD, and the Growth ETF, SCHG. First up, SCHD. This is Schwab's U.S. Dividend Equity ETF. This ETF is like your reliable friend, always there and consistent. It targets companies in the U.S. that have a record of paying out strong dividends, providing investors with a steady income stream. Next, we have SCHG, Schwab's U.S. Large Cap Growth ETF. This ETF is your ambitious, high-energy friend, always looking for the next big thing. It targets U.S. companies that have significant growth potential, meaning their earnings are expected to grow at an above-average rate compared to other companies in the market. Each of these ETFs brings something unique to the table. SCHD offers the comfort of steady dividends, while SCHG offers the thrill of potential high growth. But how do they stack up against each other? Which one could be the better fit for your investment portfolio? So buckle up as we venture into the comparison between SCHD and SCHG. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. First off, let's explore the realm of SCHD, also known as the Schwab U.S. Dividend Equity ETF. The SCHD ETF is a fund that aims to track the performance of the Dow Jones U.S. Dividend 100 Index, a benchmark that includes 100 of the highest dividend-yielding U.S. stocks. The fund is structured in a way that it invests at least 90% of its net assets in stocks that are included in the index. It is designed to provide investors with a steady income stream through dividends while also offering the potential for capital appreciation. This makes it a compelling option for those seeking both income and growth. Over the past decade, SCHD has proven to be a solid performer. It has consistently outperformed the broader market thanks to its focus on high-quality dividend-paying stocks. These stocks tend to be less volatile and more resilient during market downturns, which gives SCHD its defensive characteristics. What makes SCHD stand out from other dividend ETFs is its stringent selection criteria. The index that SCHD tracks includes only companies that have a record of paying dividends consistently for at least the past 10 years. This focus on consistency ensures that the ETF is filled with companies that have a strong track record of generating cash flow and returning it to shareholders. Moreover, SCHD also considers the financial health of the companies it includes. It uses a number of financial ratios to assess the strength of a company's balance sheet, its profitability, and its ability to generate cash flow. This results in a portfolio of companies that are not only reliable dividend payers but also financially sound. As with any investment, SCHD also comes with its share of risks. One of these is market risk, the possibility that the value of the stocks in the ETF will decrease, leading to a decline in the fund's value. Another is income risk, which is the risk that the income generated by the ETF could decrease due to cuts in dividends by the companies in the ETF. Furthermore, because SCHD focuses on dividend-paying stocks, it may not perform as well during periods when growth stocks are in favor. This is because dividend-paying stocks are typically more mature companies with slower growth rates compared to younger, faster-growing companies. Despite these risks, the benefits of investing in SCHD are clear. It offers a way to generate income, potential for capital appreciation, and a degree of protection during market downturns. Plus, its focus on financially sound dividend-paying companies provides an added layer of security for investors. Now that we've got a grasp on SCHD, it's time to delve into its counterpart, SCHG. Welcome to the sphere of SCHG, or the Schwab US Large Cap Growth ETF, as it's formally known. Now let's dive into the nitty-gritty of SCHG. This exchange-traded fund, managed by Charles Schwab, is a popular choice among investors who are looking for exposure to the U.S. large-cap growth segment of the market. It's built on the premise of investing in companies with strong growth prospects. SCHG's structure is pretty straightforward. It tracks the Dow Jones U.S. Large-Cap Growth Total Stock Market Index, which is a mouthful, but essentially it represents the growth portion of the U.S. large-cap universe. SCHG holds a broad, diversified basket of companies that are characterized by high investment returns, high growth in earnings per share, and high momentum. It's worth noting that SCHG is heavily weighted towards the technology sector, which accounts for nearly half of the ETF's portfolio. The rest is spread across consumer discretionary, healthcare, and communication services, among others. The top holdings include tech giants like Apple, Microsoft, and Amazon, which have proven to be resilient growth drivers over the years. When it comes to performance, SCHG boasts a solid track record. Over the past 5 years, SCHG has delivered an average annual return of more than 10%, surpassing the performance of many of its large-cap growth peers. This impressive growth trajectory is testament to the ETF's robust investment strategy. But what are the benefits of investing in SCHG? Firstly, its focus on growth stocks can provide investors with substantial capital appreciation over the long term. Secondly, SCHG offers a low expense ratio, meaning it's relatively cheap to own compared to other ETFs. And thirdly, it provides a high degree of liquidity, allowing investors to buy and sell shares easily. However, like any investment, SCHG is not without risks. Its heavy reliance on the technology sector means that the ETF's performance can be significantly affected by market volatility in this sector. Additionally, the growth-oriented nature of SCHG can lead to higher price fluctuations compared to value or dividend-focused ETFs. It's important for investors to weigh these potential risks against the potential rewards. So, is SCHG the right choice for you? Well, that largely depends on your investment goals and risk tolerance. If you're looking for an ETF that offers the potential for high growth and you're comfortable with a bit of volatility, then SCHG could be a worthy addition to your portfolio. Having explored both SCHD and SCHG separately, it's now time to pit them against each other. Let's continue our journey to see how these two ETFs stack up when we compare them side by side. In this financial duel, we will compare SCHD and SCHG head-to-head. Let's start with the structure. SCHD, or the Schwab US Dividend Equity ETF, is designed for investors looking for income. It aims to track the performance of high dividend-yielding U.S. stocks. On the other hand, SCHG, the Schwab US Large Cap Growth ETF, is built to monitor the performance of U.S. large cap companies with strong growth potential. So if you're in search of income, SCHD might be your go-to, while those looking for growth could lean towards SCHG. Now let's delve into the performance. Over the past 5 years, SCHD has shown some impressive results, delivering an annualized return of approximately 6%. Meanwhile, SCHG in the same time frame has outperformed with an annualized return of around 12%. But remember, past performance is not indicative of future results. It's essential to consider the overall market conditions and the economic cycle when evaluating these numbers. Next up, potential returns. With SCHD, you are likely to enjoy a steady stream of income from dividends. It's like having a cash flow machine that consistently churns out returns. SCHG, however, is more about capital appreciation. The potential returns can be significant, especially in a bull market. But remember, higher potential returns often come with higher risk. Speaking of risk, let's take a look at that. Both these ETFs come with their unique set of risks. SCHD invests in high dividend yielding stocks, which can be sensitive to interest rate changes. If interest rates rise, these stocks may underperform, impacting the overall returns of the ETF. SCHG, on the other hand, is heavily invested in growth stocks. These stocks can be volatile, and their performance is often tied to the company's growth prospects. If these companies fail to meet growth expectations, the ETF's performance could take a hit. But it's not all doom and gloom. The beauty of ETFs like SCHD and SCHG is their diversification. Both ETFs spread their investments across various sectors, minimizing the impact of any one company or sector underperforming. SCHD holds more than 100 stocks across sectors like consumer discretionary, healthcare, and information technology. SCHG, on the other hand, has over 400 holdings with a heavy emphasis on technology, consumer discretionary, and healthcare. In the end, choosing between SCHD and SCHG boils down to your investment goals and risk tolerance. If you're an income-focused investor who wants a steady stream of dividends, SCHD might be a fit. If you're willing to take on more risk for potentially higher returns and have a long-term investment horizon, SCHG could be the one for you. With this comparison, you should now have a clearer picture of which ETF might align better with your investment strategy. We've journeyed through the world of dividend and growth ETFs, specifically SCHD and SCHG, but remember, the journey doesn't end here. In the past 15 minutes, we've taken a deep dive into the world of ETFs, getting up close and personal with the Schwab US Dividend Equity ETF, SCHD, and the Schwab US Large Cap Growth ETF, SCHG. We've explored what these exchange-traded funds are, how they operate, and the unique benefits they bring to the financial table. Let's take a moment to recap what we've discussed. SCHD is a dividend ETF that targets high dividend yielding US stocks. This ETF is perfect for investors who are looking for a steady income stream, along with the potential for modest capital appreciation. On the other hand, we have SCHG, a growth ETF that targets large-cap US companies that are expected to grow at an above-average rate compared to other companies in the market. This ETF is an excellent option for investors who are interested in aggressive capital appreciation. But here's the thing, there's no one-size-fits-all answer when it comes to investing in ETFs. The right choice depends on a multitude of factors, including your investment goals, time horizon, risk tolerance, and even your current financial situation. SCHD may be more suitable for conservative investors who prefer stable dividends, while SCHG might be the better choice for more aggressive investors who are willing to accept higher volatility for potentially greater returns. The key takeaway here is that investing is not a game of chance. It's a strategic process that involves understanding your financial goals, assessing your risk tolerance, and making informed decisions. And remember, no matter how attractive an investment may seem, it's always important to do your own research. Don't just take our word for it. Dive into the data, analyze the trends, and make sure the investment aligns with your financial goals and risk appetite. Before we wrap up, let's remember that investing in ETFs is just one piece of the financial puzzle. It's part of a broader investment strategy that should also include other assets like bonds, real estate, and even cash. Diversification is key to managing risk and achieving long-term financial success. So, what's your next step? Take some time to reflect on what you've learned today. Consider how SCHD and SCHG fit into your overall investment strategy. And when you're ready, take the plunge and make your investment. Before you head off, don't forget to subscribe for more financial insights. Hit that like button if you found this video helpful, and share it to help others navigate the world of ETFs. Until next time, happy investing.